Picture a man in his late 50s, sitting at his kitchen table on a quiet Tuesday night, writing one last mortgage check after 22 years of payments. He mails it off the next morning. By Friday, the bank confirms it. The loan is gone. Here's what most people assume happens next: relief, freedom, the finish line. But that's not quite what the data shows. A 2019 study tracked people right after their debts were paid off, and something unexpected showed up in their bodies, not just their bank accounts. So, what actually changes the day that monthly payment disappears, and why does it affect people so differently depending on what they did the years leading up to it? The answer comes down to one number most homeowners never calculate: the minimum amount of income they need just to survive each month. That number quietly controls almost every decision in a household, earning six figures and still feeling behind. And not knowing how it works keeps people trapped in jobs, choices, and timelines long after they could have walked away. My name is Alex, and if you've ever done the math on your own mortgage and felt strangely uneasy instead of relieved, stay with me, because that feeling is not irrational. I'm going to show you what really happens to your finances the moment that debt disappears, and the one mistake that quietly cancels out most of the benefit. Once you understand this number, you'll start making decisions based on what you actually need, not what your bank statement makes you assume you need. That number has a name, and once you see how it works, you'll never look at a mortgage statement the same way again. The weight of the final payment. Here's a question worth asking before we go any further. What does it actually cost every single month just to keep your life running? Most people couldn't answer that without pulling out a calculator. Let's meet someone who finally did. Paul is 52. He's worked in plant maintenance for the better part of 3 decades, and his wife, Carla, manages scheduling for a regional clinic network. Together, they bring in just over $116,000 a year, right around the median for households their age. By most measures, they're doing fine. Stable jobs, decent income, a house they bought 20 years ago. They're not the couple anyone worries about. But Paul did something most people never do. One Sunday night, instead of just feeling vaguely uneasy about money, he actually wrote everything down. After taxes and retirement contributions, Paul and Carla bring home about $7,000 a month. Subtract the mortgage, $2,400, a payment they've been making for 22 years now. Subtract property taxes and insurance, another $650. Add groceries, 2 car payments, utilities, and basic home maintenance, and the number climbs to $6,820. That leaves them $180 for the entire month. After everything else, $180 is Paul and Carla's floor. It's not a budgeting term you'll find on a worksheet somewhere. It's the actual gap between an ordinary month and a month where the car breaks down, and suddenly nothing adds up. And here's what that number really does once you sit with it for a second. It doesn't just live on a spreadsheet. It follows Paul into his annual review every spring, when he quietly decides not to push back on a raise that doesn't quite keep up with inflation. It's there when Carla hears rumors about restructuring at the clinic and feels her stomach drop, even though nothing's been announced yet. It's there when their son mentions he might need help with a down payment, and they both go quiet before changing the subject. Every choice, every risk, every conversation that starts with "should we" runs through the same invisible filter. Can we still make the payment this month? Now, you might be thinking that's just what having a mortgage means. Everyone deals with this. And sure, to some degree, that's true. But most people never actually calculate their own number, which means it just operates quietly in the background, shaping decisions that look completely unrelated to the house itself. So here's the real question worth sitting with. If this number has been steering the show for over 2 decades, what happens the day it gets cut in half? Or disappears completely? Because that's not a small shift. That's not just a little extra room. For a couple like Paul and Carla, dropping that floor changes the entire shape of the years they have left before retirement. It changes what risks they're willing to take. It changes the conversations they're finally willing to have, out loud instead of avoiding. And what's strange is, the moment that number actually drops, something happens in the body before it ever shows up in the bank account. The psychology of zero. And what's strange is, the moment that number actually drops, something happens in the body before it ever shows up in the bank account. There's a finding here that genuinely caught even the researchers off guard. Published in the Proceedings of the National Academy of Sciences back in 2019, the study tracked a group of people whose debts had just been completely wiped out. Not reduced? Gone. And what showed up afterward wasn't just a cleaner balance sheet. Clinical anxiety symptoms dropped by 25 percentage points, just from the debt disappearing. These same people also started making noticeably better long-term decisions. Less impulsive, more patient. Sit with that for a second. 25 points isn't a mood shift. That's the kind of change you'd expect from medication, not from a number disappearing off a loan statement. So why would paying off a mortgage do something a raise never quite manages to do? It comes back to that floor from a minute ago. When Paul and Carla's floor drops by $2,400 a month, that's not just spare cash sitting around. Their entire baseline for survival just moved, and your nervous system, whether you've ever thought about it this way or not, has been quietly tracking that baseline the whole time. Here's where it actually plays out in real life, and this part hits differently for someone in their 50s than it would for someone in their 20s. A rough quarter at work used to mean something. Layoffs, a difficult new manager, a reorg nobody saw coming. These things carried real weight because the floor was high and there wasn't much cushion underneath it. Drop that floor and a bad quarter becomes uncomfortable instead of frightening. You can speak up in a meeting you'd normally sit through quietly. You can take the early retirement offer instead of panicking over it. You can walk away from a job that's grinding you down for one that pays less, but actually lets you breathe. That's not a small thing for someone in Paul's position. At 52, that kind of leverage with an employer matters more than it would have at 30. There's also something worth mentioning here, and it's a different conversation than you'd have with someone fresh out of college. Research on housing debt and entrepreneurship has consistently shown that lower housing costs free people up to take chances they otherwise wouldn't. But at this stage of life, that risk rarely looks like quitting to launch a business. It looks smaller and quieter. It looks like cutting back to 4 days a week 2 years earlier than planned. It looks like finally turning down the project that's been swallowing every weekend. It looks like actually taking the vacation days instead of letting them expire out of some vague guilt about being replaceable. Every dollar that used to be locked into that mortgage payment was a dollar that couldn't absorb risk. Once it's freed up, it can. So on one side of this, you've got something real and measurable. Lower anxiety, sharper decisions, more leverage at exactly the stage of life where leverage is hardest to come by. But here's the part almost nobody mentions while they're celebrating that final payment. That relief comes with a quiet trade-off, and it doesn't show up until the moment you actually need to access the money you just spent 2 decades pouring into the walls around you. The dead equity trap. That relief comes with a quiet trade-off, and it doesn't show up until the moment you actually need to access the money you just spent 2 decades pouring into the walls around you. Here's a number that should make anyone pause before throwing a payoff party. The median home price in the US right now sits at roughly $420,000, and the average homeowner carrying a mortgage currently holds about $295,000 in equity. That's a lot of paper wealth sitting around. So why are so many of these same homeowners one bad month away from real trouble? Take Diane. She's 58, works as a billing coordinator at a regional hospital, and made her final mortgage payment last fall. Her house is worth roughly $420,000, free and clear. On paper, Diane looks like she's in great shape, but Diane has about $15,000 sitting in actual cash. That's the whole liquid picture. So here's a question worth sitting with. If Diane's net worth is mostly tied up in her house, is Diane wealthy? Not really. Not in any way that helps her on a random Tuesday when something goes sideways. This is what gets called dead equity, and it's one of the least talked about risks in personal finance, mostly because it stays invisible until a crisis actually forces the issue. Say Diane loses her job. She walks into a bank and asks for a loan against her paid-off house. What happens? The bank looks at her income, not her equity. Without steady income coming in, they're very likely to turn her down. You can't eat drywall, you can't pull a few shingles off the roof and trade them for groceries. In a real emergency, a layoff, a medical bill, a furnace that dies in February, a house worth $400,000 on paper might as well be worth nothing if there's no income standing behind it. By sending every spare dollar to the bank for over 2 decades, Diane essentially traded her flexibility for a gold star on her credit report. And gold stars don't pay the electric bill. There's a second piece here that catches almost everyone off guard. People assume paying off the mortgage means the house basically becomes free. It doesn't. Property taxes don't disappear, and they tend to only move in one direction. Homeowners insurance has been climbing steadily nearly everywhere in the country, and most financial planners still recommend budgeting around 1% of your home's value every year, just for maintenance and repairs. Add that up for a $420,000 house, and you're still looking at something in the range of $800 to $1,300 a month just to legally occupy a place you supposedly own outright. So Diane didn't actually eliminate her housing cost. She shrank it and locked her flexibility away in the process. None of this means paying off the house was a mistake. The anxiety relief from a minute ago is real, and it matters. But there's a real difference between feeling secure and actually being secure, and most people never stop to ask which one they've built. Which raises a much bigger question. If paying down that mortgage early wasn't obviously the smartest move with the money, what was? The arbitrage most people get backwards. Which raises a much bigger question. If paying down that mortgage early wasn't obviously the smartest move with the money, what was? Here's something that sounds backwards the first time you hear it. Sometimes the smartest financial move is to keep owing money, not rush to pay it off. Stay with me on this one because the math is more interesting than it sounds, and it doesn't point the same direction for everyone. Banks have built an entire business model around one idea. They pay you almost nothing on your savings account, then lend that same pool of money out to someone else at 5, 6, 7%. The gap between what they pay you and what they charge somebody else, that's the whole business. It's called arbitrage, and it isn't a trick. It's just math, and in theory, anyone can use the same math themselves. Take Walter, a 55-year-old warehouse operations manager who locked in his mortgage rate a few years back at 4%. Now compare that to right now. The average 30-year fixed mortgage is currently running close to 6.5%. That gap actually matters quite a bit because it flips this entire conversation depending on when you bought your house. If Walter's rate is 4% and the stock market has historically returned somewhere around 8 to 10% a year over long stretches, then every extra dollar Walter sends toward paying off his mortgage early is a dollar pulled out of a higher performing asset and parked into a lower one. He'd be trading a better return for a worse one, mostly because the word debt makes him uncomfortable. But here's the part that should make you pause before refinancing based on something you watched on your lunch break. If you locked in your mortgage recently, somewhere close to today's 6.5%, that whole arbitrage advantage mostly disappears. The market's long-run average isn't dramatically higher than 6.5%, and markets don't move in a straight line. Some years they drop 20%. The math that worked beautifully for someone with a 3 or 4% mortgage from a few years back just doesn't hold up the same way for someone borrowing today. So this isn't a universal rule you can apply across the board. It's a math problem, and the answer depends entirely on your actual rate. There's also inflation working quietly in the background, and it picks a side. Inflation punishes people sitting on cash and rewards people holding fixed debt. With a 30-year fixed mortgage, your payment never moves, but the real value of each dollar in that payment shrinks every year. $2,000 feels heavy today. It'll feel lighter 15 years from now, while your income has likely grown. The bank absorbs that loss in value over time. You don't. Run this forward for someone like Walter, sitting on his low rate. If he took the extra cash he could have used to rush the payoff and invested it in a basic index fund instead, that single decision could generate over $1 million over 20 years, just from compounding. But notice the catch buried in there. That math only works because Walter's rate was cheap to begin with. So the real question was never whether paying off a mortgage early is smart. It's whether your specific rate makes your debt cheap or expensive. And most people have never actually run that comparison for themselves. And once you know which side of that line you're standing on, there's a much heavier question waiting underneath it. Will the asset you've spent decades building actually be enough to carry you through the years when the paycheck stops coming? Let me verify the retirement savings figures before writing this section. I'll use the most relevant verified figure for this audience, the NIRS, finding that median retirement savings for 55 to 64-year-olds is just $30,000. What retirement really costs? Will the asset you've spent decades building actually be enough to carry you through the years when the paycheck stops coming? Here's a number that should worry you more than it probably does. Among people between 55 and 64, the median amount saved for retirement across all accounts is just $30,000. not 300,000. 30. That's the actual midpoint for people who are, by most estimates, within a decade of leaving the workforce. Let that sit for a second because it changes the entire conversation we've been having. Meet Sandra. She's 61, works as a regional sales coordinator, and she's spent the last 26 years paying down a mortgage on a house that's now worth about $420,000, completely free and clear. Her retirement accounts, on the other hand, hold around $41,000. That puts her roughly in line with national figures for her age group, which honestly should be its own headline. Sandra isn't reckless. She's not someone who blew through money on things she didn't need. She raised 2 kids, kept a steady job, and did what felt responsible the entire way through. And she still finds herself sitting on a paid-off house and almost nothing in liquid retirement savings. So here's the question worth asking. If Sandra's house is worth more than her entire retirement account 10 times over, is her house actually her retirement plan? For a huge number of Americans her age, the honest answer is yes, whether they planned it that way or not. Research from the National Institute on Retirement Security shows home equity now makes up roughly a third of the average worker's total financial assets, while retirement accounts make up only about a quarter. For some households, the equity sitting in their house is genuinely worth more than everything else they own combined, including their retirement accounts and their car. And that's not necessarily a disaster, but it does mean the house has to do a job most people never designed it to do. Here's where it gets uncomfortable. A paid-off house provides shelter. It does not provide income. You can't deposit a roof into a checking account. If Sandra wants to actually live off the equity sitting in her walls, she has exactly a handful of real options, and none of them are simple. She can sell and downsize, converting equity into cash, but also uprooting her entire life at 60-something. She can take out a reverse mortgage, which comes with real costs and real fine print most people don't fully understand before signing. Or she can take on a home equity loan, which puts her right back into monthly payments, the exact thing she spent 26 years trying to escape. None of those options feel as good as I own my house outright, but all of them are far more complicated than the simple, satisfying image of mailing that final mortgage check. So the real question for someone like Sandra isn't whether she did something wrong. She didn't. The real question is whether anyone ever sat her down and explained that owning a house and being financially secure in retirement are 2 different things that happen to overlap, but don't automatically guarantee each other. And once you see that distinction clearly, there's actually a way to build both at the same time, without choosing one over the other. Let me check the current 401k contribution limits for 2026 to keep the Playbook section accurate. Verified. The standard 2026 catch-up for 50 plus is $8,000 on top of the $24,500 base, and 60 to 63 gets an $11,250 super catch-up, the synthetic payoff, and the real Playbook. The real question is whether anyone ever sat her down and explained that owning a house and being financially secure in retirement are 2 different things that happen to overlap, but don't automatically guarantee each other. Here's something that sounds almost too simple to be the answer, but it actually changes the entire equation. What if you didn't have to choose between the relief of a paid-off house and the security of real liquid savings? Both sides of everything we've covered so far actually agree on one thing, and it's something almost nobody mentions out loud. It's called lifestyle creep, and it's a quiet killer. If you free up cash, whether from paying off the mortgage or simply not rushing to, and you don't deliberately redirect it somewhere, it just evaporates. A nicer car, a kitchen remodel, a few extra dinners out each month. Within a year or 2, plenty of people find themselves earning the same income, owning the same house, and somehow feeling exactly as squeezed as they did before. So the real move isn't handing every spare dollar to the bank. It's something you might call the synthetic payoff. You keep the mortgage, especially if your rate is low, since it acts as a kind of forced discipline that stops the lifestyle creep from eating your progress. Meanwhile, you aggressively build liquid savings on the side. Once that side fund grows large enough that a modest return covers your mortgage payment on its own, you're functionally debt-free, except now you control the money instead of the bank. Take Renata, 56, a hospital administrator who spent the last few years doing exactly this, instead of rushing her own payoff. Here's roughly what her sequence has looked like, and it's worth laying out clearly because the order matters more than people think. First, she built an actual emergency fund, 6 months of expenses sitting somewhere she could reach it without penalties or paperwork. That's the foundation everything else stands on. Second, she contributes enough to her 401k to capture her full employer match. That's free money, and walking away from it is one of the few genuinely indefensible moves in personal finance. Third, because she's over 50, she's using the catch-up provisions the IRS allows. This year, that means she can put up to $24,500 into her 401k through normal contributions, plus an additional $8,000 in catch-up contributions, for a total of $32,500. If she were 60 to 63, that catch-up number jumps even higher, to $11,250. Fourth, anything left over goes into a taxable brokerage account, low-cost index funds, nothing exotic. This is the part that turns freed-up cash flow into something that actually compounds, instead of quietly disappearing into a new kitchen. This isn't a one-size-fits-all formula. Someone with a 6.5% mortgage rate from today is in a genuinely different position than someone sitting on 4%. But the sequence itself, emergency fund, employer match, catch-up contributions, then brokerage, holds up regardless of your rate. A paid-off house is a trophy. It looks great, and the feeling is real. But liquid wealth is what actually fights for you when the unexpected shows up, whether that's a job loss, a health scare, or just the freedom to choose how the next chapter of your life actually looks. The trophy and the army. So here's the realization worth sitting with. A paid-off house was never the finish line. It was one piece of a much bigger picture, and the relief you feel writing that last check is real, but it isn't the same thing as security. A few things are worth carrying forward. Debt has a real cost on your nervous system, not just your balance sheet. Your floor, the minimum you need each month, quietly shapes every decision you make long before you notice it. Equity is an income, and a house can't pay an electric bill. And the smartest move with your money almost always depends on your actual interest rate, not a feeling about debt in general. Next time you look at your own mortgage statement or your retirement balance, ask the harder question. Not, am I debt-free? But, am I actually secure? Those aren't always the same thing, and now you know why. There's still one piece we haven't covered. What happens when Social Security itself can't fully deliver what people are counting on? And that's worth its own conversation. If this helped you see your own numbers differently, I'd love to hear where you landed in the comments. And if it was useful, share it with someone who's still making that Saturday morning transfer.